Welcome to this investor webinar. With the attack on franking credits and a Royal Commission killing the culture of our financial services industry, it's more important than ever to invest offshore. And with me today is Paul Black from WCM Investment Management. Paul is the portfolio manager and co-CEO of WCM, a group that we at Contango have a relationship with. They manage our listed investment company, Contango Global Growth, and will soon be launching an exchange-traded managed fund of that same very strategy. Paul, great to have you here today, mate. How's the weather in Laguna?
Thank you, Marty. It's actually a little overcast right now, which is highly unusual, but it's still 72 degrees. Although I don't think you use Fahrenheit down there, do you?
No, we don't. But we know that 100's pretty hot, and it gets pretty hot down here.
It's fantastic here. Thank you.
Yeah, good to hear. Well, it's great to have you on board, Paul. And obviously, we know a lot about what you do, the quality of your organisation. But for those that don't know or that are joining us for the first time, tell us about WCM. How much you manage and how long you've actually been active in Australia.
Sure. We currently, as of the end of March, we managed about $27.5 billion, which was U.S. And of that amount, it's well diversified among pure international stocks and global stocks. That's kind of our forte. We've got 40 people in the firm, 30 people own shares in the company, and we have 11 principal owners. A principal owner is someone who owns at least 1% of the company or more. So we've got a really nice, diversified kind of shareholder base in the organization, which we'll talk about later, but it has a lot to do with, I think, why we've been successful. We've been coming down to Australia for at least 5 years, at least 3 times a year. So we've had a real consistent effort and consistently show up and talk to our investor base. I think right now we've got over $1 billion of client assets out of Australia. So it's not only been very good for the business, but it's a lot of fun, obviously, to come down to Australia.
Yeah, and we love having you out here. So, Paul, talk us through the unique investment process that you operate at WCM and how that differs to other global managers.
Yeah, I think what we do is every manager says what they do is unique, but I really believe that we've got some distinctive characteristics that should give people hope that the really good numbers that we've been able to put up over the last 10 years or so should continue to happen. Essentially, we're a large cap growth manager outside of, owning all companies outside of Australia. It's a fairly focused portfolio of about 32 names. That's very intentional. Because look, the reality is if you're going to act like an active manager that's looking to add excess return, you've got to build your portfolios in such a way that they can participate. And to do that, you've got to own fewer names rather than more, and you got to know those names really well. And being a growth manager, as we'll talk about further down the road, we tend to like companies that have very good, consistent earnings. They have competitive advantages that are not just wide, but they're actually getting wider. The competitive advantage is getting stronger. And we put a big premium on the cultures of the organizations. At the end of the day, we're huge believers that companies that have core values that are aligned with their competitive advantage, a core set of values that are consistent with that competitive advantage, will help that company grow substantially over the next 5, 10, and 15 years. And another important piece to what we do is, in investing, time is your friend. And unfortunately, in the nature of the beast today is people hear little snippets and sound bites, and they make decisions in very short periods of time, buying and selling stocks. The people who make a lot of money in investing are those that buy great businesses, in our case with expanding moats, and they give them time to work for them over 5, 10, and 15-year pulls. All the people, all of our clients that have created a lot of wealth for themselves and their businesses didn't do it in a week or 3 months or 6 months. They did it over a generation. So time is your friend in this business, and so we keep portfolio turnover very low.
So Paul, let's I want to spend a good amount of time on culture. but can you sort of run us through this sort of concept of the moat and the rising competitive advantage and what it actually means for the investments that you make or the investments that you look at?
Sure. Right. If you look at the industry, and there's a lot of talk about passive and that passive investing does better than active, and I would argue that that's a cycle. There are periods of time where active does much better than passive and passive does much better than active. But one of the main reasons we think that active managers don't outperform more is because they're all doing exactly the same thing, expecting different results, right? The average active investor will tell you, hey, we buy high quality businesses, right? Of course, nobody admits to buying junk, right? Of course you're going to buy quality. We want to make sure they have strong competitive advantages. Who's not going to buy a business with a strong competitive advantage? And then we want to buy them cheaply. Well, of course, you don't want to pay too much for a business. But what we have found is that more times than not, if that's all you're doing, you're likely to find yourself in value traps more than you are having a good investment result. And so over time, from our perspective, what's more important than just a big and strong competitive advantage is buying a business where the competitive advantage is actually getting stronger, where you can make the case over the next 5, 10, or 15 years that the competitive advantage is going to get stronger and better. And if you get that part of the equation right, you're going to go a long way towards having a very successful investment. So in the case of retailers, it's very simple. Great retailing concepts are all about taking their idea and kind of moving it to different locations and opening up new stores. It's a huge competitive advantage. But when you look at the core of great retailers, usually what it comes down to is what we'll talk about next, is it usually comes down to those set of values or core ideas around culture. But the notion around growing competitive advantages is very different than just buying a wide moat business, because moats change. Everybody's competitive advantage is either getting stronger or weaker. And if you buy those businesses that may have a wide moat today, but there's a disruption in their particular industry, it can absolutely destroy shareholder value in a very, very short period of time. So in our case, do your work around identifying those businesses with growing competitive advantages. 95% of our work is there. When we get it right, which we mostly do, it leads to a lot of success in the investment.
And how would that differ to, say, a company that has a wide moat or a high return on invested capital?
Well, again, we've talked about this before, Marty. You look at, let's go back and look at a wide moat business in 2007 and talk about Nokia. Every Wall Street analyst identified Nokia in 2007 as a high quality, wide moat business selling at a discount. Well, the reality, what wasn't to like? Massive returns on invested capital, upwards of 30% a year for the prior 5 years, no debt, 53% share in market, 53% share in phones, one of the top 3 brands in the world. It was a luxury brand in emerging economies, right? Brilliant. Selling at 60 cents on the dollar. Almost every Wall Street analyst had a buy recommendation on that stock in 2007. You fast forward today, we all know what happened. It was a massive destroyer of capital. The reality is Nokia was being disrupted by the iOS from Apple and the Android operating system, which allowed a lot of Asian manufacturers to make cheap phones that they could sell. That company, Nokia, ultimately was sold to Microsoft for $7 billion. Microsoft a couple of years ago wrote the whole investment off. So you can buy those really high quality businesses, but ultimately if they're being disrupted by the marketplace, they will destroy capital very quickly.
Yeah. So consumer, technology, and healthcare are the 3 of the sectors that this strategy focuses on. Why is that the case, Paul?
Well, it's interesting. It's the case because if you're a growth manager, you're looking for those high return on invested capital companies with little or no debt, lots of free cash flow, some kind of franchise or brand. And if you think about the businesses that shake out when you do that, they tend to be consumer names, healthcare names, and technology names. Now, I think this is really interesting. If you think about those particular sectors and then think about what's going on in the world today, I think there's a brilliant case to be made that owning those businesses is really the right thing to do at this time. We all know about the emerging middle class around the globe. We were in Brazil recently. If you ask the average person in Brazil, hey, did 35 million people come into the middle class in the last 5 years? They'll all affirm that it did. Is that going to happen in the next 5? You bet. Indonesia, the middle class is getting wealthier. Certainly India and China. And as an investor, we're all sitting here today trying to figure out how do you make money over the next 5 or 10 year pull. Well, one way to do it is to own a portfolio of stocks like we own, where people, as they get wealthier, are going to buy the products from those companies. So as people in Indonesia get wealthier, they're certainly going to buy higher quality consumer good products. Consumer names ought to do all right. They're going to demand better health care. They're going to pay for it. Healthcare companies should do well. And then obviously technology, our lives are full of it. As people get more money, they spend more money on technology. So the beauty of this portfolio is it just happens to be positioned in a way that we think really benefits from the consumer spend over the next 15, 20-year pull. That's not going away anytime soon. Everybody knows about it, but it's a great way to participate in that growth of wealth creation around the globe. That's just kind of a side note to it. But certainly, again, as I said, we'd rather be lucky than good in this business. And I think being in front of powerful tailwinds that are driving economic wealth is a very smart thing to do for lots of years to come.
Yeah, Paul, we've touched on it, but just define what constitutes a great growth company.
Yeah, we have touched on it, and this is what I would say is even a better way to turn that is what constitutes a high quality business. Most people would identify in our world, most people would say a high quality business is a company, as I said earlier, with little or no debt, solid balance sheet, lots of free cash flow, easy to pencil out over the next 5 years. We'd argue a high quality growth company ought to be one where the economic moat, the competitive advantage is getting stronger and stronger and stronger over a long period of time. As I said earlier, if you get that right, you're going to be successful. But I'd also add that a really good growth company ought to have a culture and a set of values that supports the underlying competitive advantage. And again, I'll use retail. In retail, when you think about great retailers, usually they have cultures that are about caring for their people, right? They want to have happy employees. And if you have a happy employee in retail, they're going to service you and me better. We're going to come back more, spend more money, and ultimately the shareholders are going to do well. So it's really important in a retailer to have this culture that's about taking care of people. Now, is that the best culture in a growth company to drive, let's say, a railroad company? Probably not. Railroads are very different animals. They're about efficiency. They're about delivering on time. Probably a different kind of culture will animate that business to success rather than a retailer. So in summary, high quality is really, it's not just about the financial metrics. Is the competitive advantage growing? That's not only high quality, but it's a great growth business. And then support that with a culture that will drive that competitive advantage to grow over time.
No, that's excellent. So, Paul, talk us through the process that you use to assess company culture at WCM.
Yeah, it's very intuitive. When you think about assessing a culture of a business, and for those that own businesses out there, the way to do that is primarily to talk to people. A lot of people think that you can assess a culture by doing some quantitative measurement or scoring system, and that's just not possible. And that's why, frankly, a lot of people don't do it, because a lot of people in our business are very, very quantitatively oriented. To assess a culture, the best thing to do is to talk to people that used to work in the organization that have left. If I wanted to know, about a particular company in Australia, I'd do everything I could to talk to former employees who left on good terms to tell me about the core values and the ideals of that business. You can talk to the CEO, you can talk to the CFO, but for the most part, you're going to get a scripted response. But having said that, you can also ask CEOs and CFOs, tell me about your culture. And if they give you a 30-second answer, then it's not important to them. But if they go on for 30 minutes and tell you things like, hey, it's an absence of fear, it's about empowering our people, it's about getting people to embrace the ideals of the organization. If they go on and on and on about it, it's probably an important part. You talk to vendors, you talk to competitors, you talk to people that kind of sell into the organization, and you talk to people left on not so good terms. So what you're doing when you're assessing a culture is you're building a mosaic. And people go, hey, can you kind of graph it and score it and then kind of rank it? And you can't. What most people know is anyone who's worked out there for a long period of time knows an unhealthy culture. They know when they worked in an unhealthy culture, and they also know what a healthy culture is. So, we're looking for those companies that are very healthy, very transparent. You can look at things like how how people are compensated. Is it 2 or 3 people at the top that are making 10, 15, $20 million, and everybody else is making a lot less? Or is it a highly incentivized structure tied to performance with high levels of accountability? That's a much better business. So again, do we know cultures perfectly? We don't. I would argue, if you're brutally honest, if I'm brutally honest about this business, businesses better when you own them. It's the same way with people that might be listening. You know investments best after you've owned them for a period of time. So we're always working to get better to understand the culture. And I will say, in the portfolio of, let's say, 33 names, there are probably 6 names in the portfolio where we think we have a perfect alignment between the values of the business and the competitive advantage of the business. And in the other areas, some are stronger, some are weaker. But where you have that alignment, those are 10 or 15-year holds. You don't sell those businesses because they're going to create an enormous amount of value for you over a long period of time.
Paul, do you think WCM has been around for a number of years, and you've been on a journey to build that business for a big part of that time? Do you think if you hadn't been through the journey of building the WCM business, that you would have been able to actually determine the importance of culture when selecting investments? If you say just worked for a big fund manager as an employee, do you think you would ever have got that culture piece?
No, that's a great question, Marty. The reality is a lot of what we know today and what we practice today has been born out of a lot of failure. I think anybody that's brutally honest about their life will acknowledge that it's the difficult periods of time of your life. It's where you've made mistakes and hopefully learned from that you've gotten better. It's funny, whenever I listen to interviews of money managers, you'd think that money managers never make mistakes, that their career trajectory was straight up, there were no hiccups. Look, everybody has hiccups in their life, and the reality is what's made us better and what's made us, I think, able to succeed and beat the markets is because we've had failures. But you know what? And we'll have more, but we will not make the same mistakes over and over again. And that's a real key part of our process. So yeah, if we had time and I took you through the mistakes that we've made historically, it would take quite a while. But you know what? We are much better today because of those mistakes. We know what to avoid, and we won't repeat them.
If we look at your business for a second, can you tell us about your moat and your culture and how that impacts your business and how that's driven the success you've had today, particularly over the last 10 years?
It is, our culture and our values have been the single most important part to our success. Look, we can talk about, I think we have a very unique philosophy. I think what we do around competitive advantages and culture are very different, very unique, an inefficiency in the market that we can exploit for a long period of time. But at the end of the day, what will allow any business, let alone our business, what will allow us to continue to do well and what's allowed us to do well over 10, 15-year pull has been the core set of values in our firm, which are, I think, very unique. And they are gratitude and fun. right? You don't hear that very often. Gratitude and fun. Most people have core values of integrity, discipline, hard work. Those are permission to play. You've got to have those. Those are just, you got to have those values to participate in the game. But to us, this notion of gratitude is an acknowledgement of how fortunate we are to do what we do in a time and a place where you're handsomely rewarded to allocate capital. People have asked me, how does gratitude help you as an investor in us? And I would argue that hopefully with gratitude, there's a level of humility that comes along, because there's an acknowledgement that, there are a lot of smart people in this business. We're probably not the smartest guys out there. There are a lot of people that work really hard. Are we going to work harder than anybody else? Probably not. But one thing we can do is we can care more about our people. And if you care more about your people, then you tend to set up a culture where people are not afraid to make mistakes. And if they make a mistake, they're not afraid of getting penalized for it. I think if I was going to define, apart from those two core values, what's really important, I don't think there's fear in this organization. There's not failure to fear, failure to fail. That's a hard one. There really isn't, and it's a very important part of who we are. And then fun is obvious. When I started at Bank of America and Wells Fargo Bank, it was not fun. There was nothing fun about it. I was one of 90,000 people, couldn't move the needle no matter what I did. I did not skip to work every day. Where here, we all skip to work. We love to work with each other. We enjoy it. Our friends are here in this organization. So I think if you have those two pieces where there's a level of humility that you have to care more about your people, and you have a lot of fun doing what you do, I'm going to argue that you're going to get the best out of everybody, and you're going to set yourself up for the greatest chance of success. And then do something a little bit differently around the philosophy and strategy. It's a good recipe for success.
Yeah, and you've definitely done that. So, Paul, lots of listeners or viewers very keen to hear, some of the companies that you're invested in right now and why.
Well, I'll give you a couple of newer thoughts and ideas, but I think if you asked what are some of your favorites in the portfolio, obviously it's really hard to argue against Amazon. We've owned Amazon since the inception of the portfolio. It is a very, very disruptive business. People wonder if it's expensive. They've been wondering that when it was selling at $56 a share. Now it's $1,600 a share. It's a massive disruptor in the industry. And to us, it's one of those names that continues to expand its economic moat that you need to own for a long period of time. A more recent purchase in the portfolio is Pernod Ricard, which is a distiller, the second largest distiller in the world. I was fortunate enough to meet recently with Alexander Ricard, who's the grandson of the founder. They make Chivas, Absolute Vodka, Jameson, a lot of pretty high quality brand names, a lot of fun in their portfolio. But to us, that company is really about owning a business that's having a massive cultural turnaround. As I said, Alexander Ricard took over as the CEO about 2 years ago. And he is the grandson of the founder, and he's instilling a culture that's really about, utilizing social networks to distribute their products. So he's completely upending an entire industry in terms of how he's looking at reaching customers, and he's doing it in a very unique way because he's only 47 years old. So he kind of gets that whole world. Another company in the portfolio we like a lot is Stryker. Stryker is a U.S.-based medical device company. They're primarily known for hips and knees. As you know, if you believe the demographics, as we all age, obviously new knees and new hips are increasingly important. But really, what makes Stryker an interesting company and why we think the moat's expanding is because of a robotics process they have called Mako, which is all about doing the minimally invasive surgeries and replacement of knees and hips robotically. They've got about 15% market share. There's nobody on the planet that's even close to them. So they ought to be able to take a lot of share in a relatively short period of time, because with robotics, the whole process is a lot more seamless. The recovery time's a lot faster. The costs are a lot lower. So they really kind of dominate that space right now, and they're looking to take a lot of share. I think those are two really interesting names that we've actually added this year.
Yeah. Just back to culture for a moment, Paul. Do these great growth companies have great cultures from the start, or is it something that gets learnt along the way? And how long do you believe, and have you done any research on this, does it take to actually turn a company's culture around, and can it be done?
Well, I'll tell you what you can do is you can crush a great culture really fast. If you've been a company that has been operated in let's say a very decentralized entrepreneurial manner, and then sometimes companies will bring CEOs in from the outside thinking they can make it more efficient, and those outsiders don't tend to get the core values of the business. And we've seen really great companies get crushed by a new operator that comes in from the outside. So I'd argue it's a little bit of both. A lot of the companies that you see in the portfolio today have always had cultures that are aligned with their competitive advantage. That's what we prefer. But there are situations like Boston Scientific, which is another healthcare company, where we own the company because we believe that there's a massive cultural turnaround going on that ought to be able to unlock an awful lot of value in the portfolio. The preferred method, own the companies where it was ingrained from the beginning, but there's also opportunities to own those businesses where there's a cultural turnaround going on right now. You can play a little bit of both.
Paul, the portfolio is sort of 50% US, 50% rest of the world. With the growth in China, do you see that changing in the coming years?
I'm glad you brought that up, because if you ask me, what are the obvious places to invest in the portfolio, and the obvious is China. You can't bet against China, and there are different ways to play that, right? You can own companies like Tencent, which makes the WeChat app, which is owned by 700 million people, and it's into mobile payments, and anybody that wants to do anything in China uses that application. It's a very powerful, it's kind of a combination of Facebook and Google and Instagram in one company. You got to own that company. But there are other ways to play it, like, again, with Pernod Ricard. You look at, here's an old school distiller, but they're selling their product, on the high end into China in an increasing way. So yeah, to answer your question, it's really important to have a foothold, either owning local companies in China or owning companies that are selling into China. Again, who knows what the true growth rate in China is, but I'll tell you, it's very, very fast. And that they are competing with the West everywhere. You've got to own a piece of that. There are different ways to do it. Old school kind of, developed market companies, and then some of your emerging economy companies as well.
Yeah.
We're actually buying a name right now in the portfolio that I can't talk about, but it's a big play on China.
Okay. Oh, we'll stay tuned for that. Now, Paul, the track record of this strategy has been, outstanding. Sort of, 5% outperformance, or greater than 5% outperformance over the last 10 years. What can investors expect from this strategy in down markets?
Again, a good question. What they can expect is that we will do extremely well in difficult markets. It's interesting because when people hear, oh, they're a growth stock investor and they own about 33 names in the portfolio, the first thing that people think is there must be more volatility or risk, and probably they don't do as well as the market when the market's dislocating. The truth is very different. We only get about 65 or 60% of the market's downside when the market's down. That's by design. We want to make sure that when things get tough, we do really well. And the math is really obvious, right? If you lose less in a down market, you don't have to make up as much in a rising market. So what the client can expect is tough markets World's being dislocated. WCM is going to do much better than the market in that time frame. And when things turn, because we're buying those companies with expanding moats, with quality, with high quality cultures, that those companies will continue to do well in a rising market as well. So the key is, you know, if you look at our track record, it's brilliant. The questions that I would have as an investor is, okay, good for you, WCM. That was other people's money. Why should I have any belief that you're going to do well in the future? Well, to me, it has to do with those whole ideas around being in the right place at the right time, in front of the rising middle class, owning those companies with expanding moats that are supported by a culture and a core value. That should drive us to a lot of excess return in the future as well.
Okay. That's excellent stuff. Now, Paul, we've got some questions from some of our audience. I'm just going to read the first one out. It's just come through via the chat app. If anyone does want to ask a question, on the right hand side of your screen, there'll be a button that says chat. Click on that, enter your question, put it away, and the team will pass it along. Got a question from Neville Vickery. Paul, this is from Neville. Is it really a good time to enter any global fund, given the length of this bull market and the talk of an inevitable slowdown?
Yeah, well, that's an interesting question, and it's a question we've been getting for 7 years, and for 5 years we've been getting the question down in Australia, is this a good time to own growth? And my argument has always been, the reality is nobody knows when the markets are going to dislocate. You know, when people set up a plan, they should have a long-term plan with allocations to growth, value in different other areas, and then they should commit to that growth. You know, when you look at our portfolio, let's just say you are concerned about the high levels of the market right now, then I would argue this portfolio is the best way to enter it, because if the market pulls back for a short period of time, we are going to do much better than any other manager out there, and really any other asset class. So if there are concerns, this is a good way to enter the market. But I'd also argue the best thing to do is, if you have a long enough time horizon, 5, 10 years, it doesn't matter where you enter the market. It really doesn't matter. If your time horizon is 1 year or 2 years, you shouldn't be invested in equities. But if it's 5 and 10 years, it doesn't matter when you enter the market.
Yeah. Okay. So we've got another question here. Ed, is this a live one from Julie? No, it's not. It's from the chat. How is the issue of data privacy, or is the issue of data privacy, affecting the value of the tech stocks in the portfolio?
I don't think so. Perhaps it has with Facebook. A little bit, but actually what that whole breach created was a great opportunity to buy one of the best growth businesses in the world for a very good price. You know, people don't know this, but Facebook today is priced higher than it was before the breach with Cambridge. And, you know, today it actually trades at a higher level than it did before that breach. So no, we don't. I don't think in general, when you look at the tech stocks in the portfolio, that they're being kind of compressed because of data breaches.
So is Facebook in the portfolio now, Paul?
Yes, it is.
Okay.
It is.
Next question. We've got it here. Okay. I've got a question from Ian Newbury. What about India as a market, as the middle class is growing?
Yeah, there are a number of ways. So, yeah, again, it's a good market. It's not as easy for us to play, or for anyone to play, as it is with China. But you do have the emerging middle class. You have some move to free markets there, but there's still, from our perspective, a lot of regulatory overhang that makes it kind of a difficult place to be. The company that we're actually in the process of buying right now is not only a pretty good play on what's going on in China, but it's also a very good play on India as well. So you have to be careful with India, but there are certainly some opportunities there to take advantage of. We own a bank, HDFC, in the portfolio. that really gives us exposure to the emerging consumers, in that country. It's dislocating kind of the public sector and the public banks. We think it's a really good 5-10 year pull company.
Okay. So the next question is from Tony Santoro. Is the fund a long only fund, Paul? There's no shorting, is there?
There is no shorting. It's long only.
Yep.
Nobody makes money on the shorts. Shorts are there for hedge funds to charge 2% plus 20.
Yeah.
You make your money on the longs.
Okay.
Yeah.
Ed, how are we going there? Okay. Next question is from Daisy Chi. How tax efficient is your fund for Australian investors? Is it structured
properly so that we minimise withholding taxes?
Is it structured properly so that we minimise withholding taxes? That's really something that we'd probably need to speak with your accountant about. But Paul, can you have a crack at that?
Yeah, I'd say it is. It's a very low turnover strategy. Roughly, we turn over the portfolio about 20% a year. So again, if you're going to own an investment portfolio, your goal should be, and it's taxable, your goal should be to have as low a turnover as you possibly can in the portfolio. Ours is around 20%, which is on the very low end of that. So in general, it's a fairly tax efficient strategy for taxable investors.
Yeah. Okay. Another question here relates, this is from Tom Kenny. After the findings, Paul, we've had a big Royal Commission in Australia. I'm not sure whether you've heard with regards to our financial services industry, and the culture of those organisations were deemed to be toxic. We sort of covered this before, but I think maybe we could put a bit more colour to it. How hard is it to turn around a culture and, as a result, improve performance, share price performance is the question.
Oh, let's just argue this. With a bank, it's impossible. It's really some businesses are just impossible to turn around culturally, and typically banks, I said that tongue in cheek, but typically banks are not great investments because it's really hard to identify what their competitive advantage is vis-a-vis other banks. But it's hard. The bigger the organization, obviously, the harder it is to turn around culturally. So to me, we would only look at opportunities of a cultural turnaround with a smaller company, relatively speaking, where there's an ability to affect change in a shorter period of time. Because we're willing to wait 3 and 5 years, but we don't want to wait 5 and 7 and 10 years for that cultural turnaround to translate into profitability in the stock.
Yeah. Okay. The next question is from Chris Mee. What about China's expansion into the Asia Pacific? Do you consider this a geopolitical risk?
I'm the wrong person to ask. We don't make any prognostications about anything that has to do with geopolitical risk. And you know why we don't do it? It's because we're always wrong whenever we do. And actually, I should run a fund that says, okay, I think there's a risk here in the world, so we should get out. And what I ought to do is say, no, I'm not going to get out. I'm going to go in because I'm going to be wrong on my assessment. So assessing geopolitical risks, while it might kind of scratch your ear and kind of feel good, it really is a loser's game when it comes to investing. Nobody makes money trying to invest based on geopolitical risks. You buy these great businesses and stable regimes. You let them work for you. You give them time. You make sure there's an expanding moat with a culture that supports it, and you stay out of the way. That's how you make money. But jumping in and out of the market, I mean, if we jumped at every geopolitical risk that flares its ugly head, we'd never be invested.
Yeah. Yeah. Next one's another question from Chris. Do you have investments here in Australia? And if so, can you name them? Now, I will say that this strategy is ex-Australia, but have you and do you invest in Australian companies, Paul?
We do in our pure international portfolio, which in the U.S. is ex-U.S. We own CSL. It's actually one of our top holdings in the portfolio. It's been a tremendous investment for us. We were always looking. It's tougher because the Australian market's really dominated by the financials and the basic materials, which is not where we kind of play. But we do own CLS in our international portfolio.
Okay, thank you.
Which I know international is the same for you.
Yeah. So the next question is one that I'll answer this one, Paul. It's related to Contango Global Growth, the listed investment company. And the question is, does CQG intend to pay a dividend in the future, or is it an entirely a growth stock? So I think first and foremost that this strategy is focused on growth. It's not a strategy that's designed for income. Notwithstanding that, that there is a possibility that the LIC will pay a dividend at the end of the financial year, and that's currently with the board of Contango Global Growth for consideration, and more information will be provided on that in the coming months. So thanks for that question, Jennifer. The next question is from Malcolm Brown. And this is probably another one for me, Paul. There was a mention in the opening remarks that an ETF will be coming. Where will that ETF be listed and when? So yeah, we have announced to the market that we are going to be launching an active ETF, or what they call here an exchange traded managed fund that will be branded WCM. It will be an open-ended version of the WCM strategy, which is different to the LIC, which is a closed-ended fund. That fund, yes, will be listed on the ASX, and you'll be able to buy that like any normal security. The timing is currently the documentation's with the regulator, so we don't have an exact date, but we expect that to launch in the next couple of months. And so it's currently with the regulators, and we hope that will be finalised shortly. That's all I can say at this time, but we'll definitely be keeping you across when that's ready to go. Okay, we've got a question from Stuart Hudson, and this is for you, Paul. Why do you sell or reduce a holding? Do you take profit if the return is immediate?
Yeah, if the return is immediate and rapid and great, we will take profits. Trees don't grow to the sky, as they say. And one of the pieces that's really important when you're managing a portfolio is if you have a name or a stock that moves very fast in a short period of time and to a great extent, you've got to take profits in that. We have paired one of our favorite holdings is a company called Tencent that I mentioned earlier, which is basically an internet company in China. It was up 100% last year. The probabilities of it growing 100% this year are pretty low. So we did take 2% away from the position. So that's a good question. It's really important to manage the portfolio in a way that you take money from your winners and you put it into the companies that you really believe in the fundamental process of the expanding moat, but the company stock hasn't moved greatly. So this constant sense of rebalancing the portfolio away from the winners into the ones that haven't done so well in the short term is a brilliant way to protect the portfolio in difficult markets. It's what everybody should do, but most people can't do it because they just want to believe that their winners are going to keep winning time and time again. And every company goes through a cycle. So you've got to take those profits.
Okay. And we're unfortunately out of time. Paul, it was an absolute honor speaking with you today, and we're very grateful to be representing you here in Australia. Your colleague and business partner Kurt will be out in a couple of weeks, and we look forward to showing him around town. Thanks very much for your time today, mate.
Thank you, Marty. Wish I was coming down there myself. I'm looking forward to a meal at Vlado's in Melbourne.
We'll definitely do that together soon, mate. Thank you very much. And stay tuned. More information will be coming shortly through the respective channels with regards to this new exchange traded managed fund that we're launching with WCM. So thanks again, Paul, and we'll chat with you soon.
Thank you, Marty.